What's up guys, Jake here. If you clicked on this video, then potentially you're in the process of buying a home and you've reached a certain point called the underwriting process. Now, for a lot of people, this can be stressful because you're so close to purchasing a home. So in this video, let's cover the underwriting process and talk about the who, what, and why. But before we go any further, I must tell you that I am not an underwriter, I am not a loan officer, I am not a real estate agent. I'm not trying to sell you on any service in this video. I'm just some guy on YouTube that likes making educational content. If you enjoy these kinds of videos, give me a thumbs up. Really helps out my channel. Now, when applying for a mortgage, there are three kinds of conforming loans. There is VA, FHA, and conventional. Most people watching this video, you're just going for a conventional loan. If you're FHA or VA, you know who you are. But what does that mean, a conforming loan? And it means that the lender that you're partnering with, they have to meet certain guidelines set by the government in order to be eligible to repackage and resell your mortgage as a security to the mortgage security companies. These are Freddie Mac, Fannie Mae, and Ginnie Mae. Maybe you've heard of them. So it's not the lender's criteria. It's these three entities mostly setting what are the guidelines in order to be eligible for a mortgage. If you want to know what these guidelines are, you can just Google them. For example, FHA loan requirements. The top website is FHA.com. FHA loan requirements in 2021. Year to year, they can shift a little bit. But maybe you want to go to the government source directly. This is HUD's website, the U.S. Department of Housing and Urban Development. So it doesn't matter which loan officer you partner with, whether it's a credit union, a bank, or a national lender, it's not their guidelines. Perhaps you can get better customer service from one institution over another, but just know that when they're talking to you, they're trying to meet up the government guidelines in order to have your loan become a conforming loan. It's at this point that your loan officer is going to ask you a bunch of questions. They're going to want to know your credit score, your debt-to-income ratio. This is your monthly debt payments like car payments, student loans, credit cards, divided by your monthly gross income. They're going to want to know how much of a down payment can you afford, and do you have any assets that you can list? And then finally, what is your annual income and your employment? Your loan officer is taking your information in order to put it into a computer program. Loan officers use software called Desktop Underwriter. They're put out by the mortgage security companies, and anyone can create a profile and a password and use this software to input certain variables to see, does it meet the conforming guidelines. Your loan officer cannot give you final approval for your loan. I know this is kind of counterintuitive. They're the person working at the bank. Don't they get final say whether or not I get the loan? And no, they don't. The underwriter is the person who gives final approval on the loan. There is an additional person at this point who works with the loan officer, and that would be the loan processor. This is the person that you're probably going to send all of your necessary paperwork to. They're going to want your last 2 years worth of tax returns, maybe the last couple months worth of bank statements, and some pay stubs. And you're going to package all of this information together, and the loan processor is the one who prepares this for the underwriter. A useful point I can give you at this point when sending all of these sensitive documents is to maybe send them encrypted, or perhaps send a link that is password protected. Sending it through a Gmail account sometimes isn't the most secure with your private information. Okay, now, who is the underwriter? And the underwriter is a person who takes on and assesses financial risk. Underwriters are used with large loans, insurance policies, and investments. So for example, when a company is pre-IPO, they have to go through the scrutiny of underwriters to determine their valuation. And the name underwriter just comes from the contract. They would sign underneath it saying that they've gone through this contract and they've verified all the information, and financially it makes sense. So the underwriter is ultimately who's going to give final approval for your mortgage loan, and you don't talk to this person. Your mortgage lender is the in-between. So if the underwriter doesn't understand something or has questions or needs additional documentation, they're going to contact the mortgage lender, your loan officer, and then the loan officer is going to contact you. So anytime they need additional information or they have questions, be sure you respond to your loan officer immediately so your loan officer can then respond to the underwriter. Every day you delay responding, potentially that's one more day that it takes to close on your home. And the underwriter is the final person giving a legal guarantee to the mortgage security companies that both you and your lender are being truthful with your mortgage loan. If you're by chance being untruthful in your mortgage loan, then you're committing mortgage fraud. So once again, the underwriter is going to go through and verify your credit score, your debt to income ratio, down payments and assets, income and employment, the home appraisal, which is something you do once the house is under contract. They're going to verify that the home is fair market value for the loan. Additionally, they have advanced tools in order to verify certain things. So, for example, when you get to the underwriting process, something that often happens is that a person is still legally married. Perhaps they've been separated and living in separate states for over 10 years. But if you apply for a mortgage and you're still legally married in one of the 50 states, then your spouse potentially has to have their credit pulled as well. So the underwriter has ways of catching this. Additionally, they might also call your employer to verify your income or your hours. If you potentially in the last month or two have had experienced reduced hours, that can affect your qualifying income, which can affect what the loan amount eligible at this point in the process. The underwriter doesn't want to deny your loan. They want to approve everyone. They just have to make sure that everybody meets their guidelines. Some final tips for you is just know that with the underwriting process, it often is in two phases. There is the initial approval period with conditions, meaning they're going to tell their loan officer, hey, I need some additional documentation or information pending final approval. And once again, as we covered earlier, respond quickly, provide the documentation in a timely and accurate manner in order to not delay closing on your home. And then finally, don't change anything about your financial situation once you're under contract to buy a home. If you take on a car loan and finance it or open up a new credit card, this can affect your credit score and credit eligibility, and this might cause the underwriter to not approve your loan. There you have it, guys. That's the who, what, and why of the mortgage underwriting process. If you guys enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, or you know more than I do, let us all know in a comment down below. I love hearing from you guys. Till the next video, take care.